As you all know, every single Wednesday, I like to host an interview with a real-life trader, just ask them questions about their journey, ask them where they're going, where they've been, what they're doing next, their struggles, their insights, their strategies, and just learn from them and grow with them. Today, I had the privilege and honor of interviewing a good friend of mine, trading buddy, Mr. Dennis Dick, who is also the co-host of the Benzinga Pre-Market Prep Show. Dennis, welcome.
How you doing today? How's it going?
Dude, doing really good, man. How about yourself?
You riding this bull market?
Yes.
Nice.
Riding it hard. Netflix.
Ride the bull.
Riding the bull, man.
Excellent.
Feeling good so far.
Excellent.
How about yourself?
Yeah. I actually, believe it or not, usually middle of the day here, this is my downtime. So my hours are kind of funny. I'm very big in the pre-market, very big after hours, very big at the open. Middle of the day, 1 o'clock, that's my downtime. That's when I'm actually probably not at my computer screen. So it's always a lot of chop. The moves aren't as smooth in the middle of the day. So that's actually when I try to maybe do some homework, figure some stuff out, maybe even, take a little time with my family. But middle of the day is my downtime. I'm usually typically done before 11 a.m. Eastern, and I come back to the screen usually around 2 or 3. So the middle 3 hours of the day that I've always found the choppiest, that's usually when I am not trading.
Which is another reason why I want to chat with you, because that's such an interesting strategy. I would love to know more about just your pre-market and post-market trading. So you're mostly a news trader, right?
Yeah, and the thing is, middle of the day, there's very little news normally. So
right.
I'm primarily, what I call myself is information arbitrage. So I'm basically, trying to trade news, but also trying to take advantage of market inefficiencies. So I'm not so much of a, technical trader where I respect the technicals and I look at the technicals, but I call myself more of an inefficiency trader where I'm trying to take advantage of little market micro inefficiencies. And I've been, just some background on me, I started proprietary trading with Bright Trading in 1999. So I've been a prop trader for 19 years. Averaging anywhere from probably, it's actually come down as of late, but back in the mid 2000s, I was probably doing 500 to 1,000 trades a day. So a lot of that automated. Yeah, a lot of that automated, a lot of that manual as well. So sure. I can remember in the financial crisis, I was averaging a trade every 3 to 4 seconds. So working probably 50 to 100 positions at any one time. These were all intraday trades. So it's not like I'm managing 50 or 100 positions. These are 50 or 100 positions I've initiated and exiting during the day, but they're just cycling. So, throughout the day, I might have 300, 400, or 500 different positions. This is mid 2000s when there's a lot going on. Now I typically probably have on average 30 to 40 positions. Most of them maybe entered during, after hours. Some of them might have been on the close. I'm a big fan of overnight moves, so I trade a lot of overnight stuff as well. So lots of different things.
That's phenomenal. So tell me just a little bit more about the inefficiencies of the markets. I mean, when you're saying inefficiencies, are you looking at price where there's a lot of bids and a lot of asks at specific levels and the stock hasn't caught up to that? Or are you looking for volume that is obviously going to push the market higher and you're just going to load in and load out?
Well, funny, years ago, I would say yes. So when I started in 1999, 2000, 2001, looking at the order book was a huge advantage. And even to where they didn't even have, the NYSE open book, which is the specialist book on the floor. They now call them designated market makers. They didn't make that public till 2003 or 2004. So that information there was just available to the specialists back on the floor. So they had a huge trading advantage. All that information is out in the open now. If you're looking at order books now in the middle of the day, they're kind of littered with what I would say is orders that are not stable. What these are is envelope orders by market makers. So high frequency market makers, the majority of your market makers now, what they do is surround where the fair value of the price is with envelope orders. So often you'll see floating orders where you see 1,000 shares, 2,000 shares or something, and then you hit it for 200 and it backs off. So basically it's very difficult to find those stable orders. So I'm not so much of an order book reader. I do use that in the pre-market because I think that's where you see the real orders to a certain extent.
Right.
But when I'm talking market micro inefficiencies, I'm talking about relationships, what is happening, looking at news. So For example, last night you had NOC, which is Northrop Grumman, raise guidance. So automatically, you're trying to grab NOC if you can on that news, but there's usually nothing after hours. But you might be able to grab some of the sympathy plays. So if NOC is raising guidance, maybe you're going to see a Lockheed Martin show some strength. Maybe you're going to see a General Dynamics. Maybe you're going to see a Boeing show some strength. That worked in the case of Boeing today. LMT and General Dynamics both opened up, but they've kind of leaked since then. So sometimes sympathy plays can work, sometimes it can't. But as a trader and as a prop trader, you really live in the law of large numbers. So as you put on more and more trades, if you have a 55% edge and you're putting on 200 to 300 trades a day, you're probably going to make money on any given day. Now, you might only make on 45 or 55% of your given trades. So on any given trade, it's, you might lose on. But as you incorporate more and more of these strategies that you have a slight edge on, it tends to work itself out.
Interesting. So, regarding the liquidity of post-market, you putting these many orders. What's your fill rate? Are there times where you do not get filled?
Yeah, and post-market stuff is a little bit different. I trade a lot on the close too. So I like overnight setups where I see something that has strength going into the close. That often follows through. I talk about on the pre-market prep show all the time. I call it the 2-day move, where you often see a stock that hasn't, and the best setup is a stock that hasn't done much for a while. All of a sudden has a nice green candle, it's moving, it closes strong. Usually that strength will follow through the next day. So a lot of times what I like to do is jump and actually buy that stock on the close, hold it overnight, hoping for a follow-through move in the morning. I call these guys like the Johnny-come-latelys because you have a lot of people, a lot of investors have day jobs. So they are looking at the market on a closing basis, they're looking at it at night. Well, they come in and they see a big move in a stock all of a sudden, they're like, wow, that thing's going to go, I want to buy that. They put their orders in overnight. Those can help the stock to open up higher the next day. So my typical 2-day move is to buy it overnight on stocks that are closing strong and then sell into the opening strength the next morning, maybe on the open, maybe a few minutes after the open, but typically out within the first 15 or 20 minutes, depending on the strength. But this is a momentum market we're in. And when the ball gets going in one direction, it can go for a while. So we like to play a lot of these names. And there's been some good ones as of late, like our one guy in the chat, Spinner, in our own pre-market chat, he's been talking about this SOGO, which is SOGO. And that thing just blasted off 3 days ago. You can see the big green candle on SOGO. Yep. Took off from 980 up to, and actually that day went over $11, which was once it took out the $10 breakout, we were kind of playing that from a technical basis. It was a flat out breakout, but then it kept going. Well, I bought the stock and I held. I actually took a good chunk of the move. I'm actually still long a little bit of this too as a swing trade, but as a day trade, I'm out. But the next day I bought and basically I closed at 1089, and I'm like, I think there'll be follow through the next day. The next day the stock opened 1153. So you're talking about a 60-cent move on $11 stock from the 2-day move overnight. So it worked well. So absolutely. Typical trades like that can work well. Sometimes they don't. Again, we live in the law of numbers, the large numbers there. So like I said, sometimes these aren't going to work out. And when you have 50 or 100 positions on, it's basically about, managing the losers efficiently, like cutting those losers as quickly as you can. I'm always one that, 19 years, I wouldn't be in business 19 years if I didn't have discipline. So I'm very, I give my losers a very short leash. Usually I'm entering something that I think, I've got a statistical edge on. And if it starts moving back, and going against me on it, it's telling me that, maybe I'm on the wrong side of the trade. So I will typically try to get out of those as quickly as I can.
Makes sense. Do you do mostly long or do you do some shorts as well?
Yeah, I trade market neutral. So I'm doing long and short. So what market neutral means is I want to try to take out, I'm basically trying to extract the beta of the market inefficiencies that I'm finding. So I'm not worried about the alpha of the market. So if the market's up, that doesn't matter to me. I'm going to be hedged. So I'm trading usually market neutral, which is hedged. So let's say I'm long, $300,000 worth of stock and I'm uncomfortable to be long that much. What I will usually do is look and maybe short $300,000 worth of SPY against it, because now I've taken out the market risk. So if I'm trying to take advantage of, a market move up in SOGO, well, if the market crashes down tomorrow, that's SOGO is going down no matter what. So I'm trying to extract that, alpha or that, that little bit of alpha from the SOGO and not the beta. And that's why I trade market neutral. And it works, in a bull market, you're probably better not to trade market neutral. But, I've been around 19 years. I've been through some bear markets. I've been through some sideways markets.
Yeah.
And I've always traded market neutral. So it's an edge where I'm trying to just move away from the overall market moves and trying to just extract the alpha of my strategy.
Gotcha. I love that. By the
So
way,
I do a lot of shorts.
yeah.
And I will say, and you can look at, and a lot of traders, they're going to have their worst years in years like 2007, 2008, 2009. My best years are down years, big down years, because that's like the baby getting thrown out with the bathwater. You see market inefficiencies all over the place. My best trading year ever was 2008, and that was right during the financial crisis.
Right.
So my prior to that, my best year was 2001, which was the tech bubble burst.
Wow.
So always my best years are going to be in down markets because inefficiencies get wider. And if you're playing any type of market making role, and I used to do a lot of market making, a lot of strategies that high frequency traders do now, the spreads get wider. So as spreads get wider, you're going to make more money. In February, when the VIX blew up to 29, I made about 3 times what I normally am making in a month in February. So I will say my profits are very correlated to the VIX. When the VIX is at 11 or 12, I'm making a living. When the VIX is at 25 or 30, I'm having really good months.
Yeah,
so
you're having a blast.
Yeah, and then when the VIX is 40 or 90 during the financial crisis, it just gets silly. And that's just, taking advantage of little market micro inefficiencies. The statistical arbitrage is, just looking at like different types of pairs trading. Like if you've got relationships, and you can look at straight up arbitrage too. I mean, I used to do a lot of like VIA versus VIAB. It's difficult to trade those strategies now because one, the VIA is fairly illiquid, more illiquid than it used to be. And also it's kind of monopolized by high frequency traders. So the arbitrage strategy, the pure arb stuff, like, VIA versus VIAB, is kind of more difficult to trade. So now we kind of incorporate a little more risk, maybe hold some stuff overnight, but we find we still, can make some money from statistical advantages, not straight up arbitrage though. So I'm more of a stat arb guy, not a pure arb guy. I used to be a pure arb guy. Now I'm more of a stat arb guy.
Gotcha.
Adjusting for high frequency traders.
By the way, it feels good to have. I'm in a swing trade with you on this, man. So that feels.
Are you in the SoGo?
Yeah, bro.
Yeah, nice there, buddy.
Yeah.
What are you saying on this one? So how's it? Where's your stop out on this one? Are you raising it up?
I'm gonna hold it for about a week or two, but 9.14 is my stop. I'll exit a little bit at 12.32.
Yeah, and this is, a nice setup here. This is a stock that's obviously benefiting from all the moves we've seen in Chinese stocks as of late.
Yeah.
And I mean, you can look at some of the ones that kickstarted this move was this IQ. So if you look at this is, they say, the Netflix of China. It's hard to really find fundamental information on a lot of these companies over in China. Newer IPO, but I mean, this stock has went in the last month from 15.30, so it's doubled. This was kind of one of the darlings there. You've seen some other plays like BILI, Bilibili. You've seen HUYA. I've been playing these a little bit as well. HUYA reported earnings today. It was off a little bit on that. But all these stocks tend to move somewhat in tandem together. And this is what I'm talking about as, little, statistical advantages. So, for instance, HUYA, which reported last night, is probably going to be the leader of over IQ and BILI. So HUYA actually opened up this morning, but then tanked. So I was actually able to get a short off on IQ right around just after they opened at around $30, and it quickly came in because it's kind of chasing the HUYA pricing. And if you look, you can see and put those two on a chart, they're kind of moving together. Now, the companies aren't necessarily anything to do with each other fundamentally, but they're small Chinese stocks, newer IPOs, and they kind of trade together. So I look at correlations a lot, and those two stocks right now are correlated together, HUYA. So those two stocks are correlated together, and I'm going to try to take advantage of that relationship. And even though it's not a long-term historical relationship, it's a recent relationship that I've identified, and sometimes those can be the best ones.
Agreed. Oh, so what does HUYA do? Do you know exactly?
HUYA, fundamentally, I don't know what a lot of these things do. But it is, smaller Chinese play on a lot of this is streaming video. So HUYA is a newer one to me. I've only been actually monitoring for the last 7 sessions. I mean, it just came out on May 11th, so it's very recent. But I believe it's a play on streaming. These are all kind of plays on streaming video in China. Now, if I'm wrong on that, don't take me out. And this, it goes to show you too. You don't have to know a lot about the fundamentals on a lot of companies.
Agreed. Totally.
You just need to know how they're trading and, and from my perspective is how they're related to other companies. So a tip off for me this morning was if you bring up the chart of YY, which is another fairly widely followed Chinese play, stock had been running up significantly into earnings and reported a pretty good report, but then tanked on it. So that was already a tip off for me on HUYA, is that this could do the same thing. And HUYA reported really good numbers. It opened and tanked. So I was already kind of prepared for that. And that's just your pre-market preparation. Like typically I start preparing for my trading day at 7 o'clock in the morning Eastern, which is 2.5 hours before the open. Getting all the news overnight, finding and filling, looking at what's happened in the pre-market, how has things been trading, what reported last night, making sure I understand, everything that's happening so I don't get thrown a curveball on some information that I didn't know about.
Dude, totally. So one of the things that you mentioned earlier, which is intriguing to a lot of others, I'm sure, was bright trading. Can you tell us what that is and how you use that prop money to trade?
Yeah, okay. So stocktrading.com is our company's website there. So if you go to stocktrading.com, you can actually see the website and what we're all about. So I started trading retail in 1996. Just like everybody else, I had your typical E-Trade account, I believe it was back then. I don't know if it was E-Trade back then. It's funny, it's trying to remember. I think I had an E-Trade account, and I also just had, I'm Canadian, and I had one of the discount brokerage accounts.
Right.
Like Royal Bank Action Director or something was called back then. And I was just, playing a lot of penny stocks, playing a lot of smaller things, small amount of money. My parents had a little bit of money. I started trying to manage their money a little bit too. And it was a bull market, 96, 99. So it was like I could do no wrong. It looked like, I probably didn't know what the hell I was doing, but I was making money because I was primarily a long trader. And obviously, the market was going straight up in those years. So 9 out of 10 stocks you buy are going to go up. So I would say I wasn't skilled back then. I was just lucky that I was in a really, bullish environment. Then I started with bright trading in 1999, and I started to learn. I really learned that I didn't know what I was doing. So bright trading, just a history on this, was started by Don Bright and Bob Bright and Eddie Franco back in 1992. They basically, they were floor traders previous to that. Traded the floor in the 80s, 90s. They made a lot of money doing options, arbitrage on the floor. Bob Bright started, the whole he was one that actually was very involved with put call parity, taking advantages of different market micro inefficiencies that were on the floor back then. A mathematical genius, really, Bob. But he could see the floor. Way back then that, hey, we have this internet now. We can do the things we're doing on the floor from a computer screen. So Bob started the company in 1992, kind of really got going in 93. I joined in 1999. So bright trading basically just backs traders. So if you come in with, I believe actually our minimum requirement now is $50,000. So if you come in with $50,000 of your own money, Bright will give you up to 20-to-1 leverage. So basically with 50 grand, you can play with $1 million. Now that can, make some sense, because if you've got a small account, let's say you've got $50,000 and you make 10% on your money a year, which is a pretty good year, that's only 5 grand. I mean, if you're using margin 2-to-1, maybe that's 10 grand, but it's hard to live on that. Yeah. Now, if you're playing with $1 million, now you can do something with that. So, we're looking at people who are not doing this as a side thing, people who are doing this for a living. So if you've got a day job, we're not interested in somebody that's got a day job. We're interested in career traders, somebody that's looking to trade as a business, looking to take advantage of statistical, analysis and take advantage of market micro inefficiencies. But the biggest thing that we do is we provide traders with the capital to be able to employ large amounts of strategies and extract small amounts of profits from those strategies.
Gotcha, man. 20-to-1. So does Bright have a broker dealer? Do they take a spread on that, or is it?
Yeah, Bright actually, their cut is, and we're in profit sharing. So when you are, and I'm kind of grandfathered in, so I've got a little bit of a sweetheart deal because I've been with them for 20 years.
Yeah.
So a typical trader coming in, it's 80-20 split. Gotcha. So that's what Bright is taking from you. So typically they will come in, and you can basically trade back at the end of the year. So they do charge 0.5 cents a share, half a cent a share. So 1,000 shares trade is $5. There's volume discounts though. You can get 0.3. So basically, if you're, and I have that volume discount, so if you get up to that, then 1,000 shares cost you $3. Yep. So fairly cheap, and it means you're making money. If you make a penny on a trade, you're obviously making money.
Yeah.
Now, again, because we're in the profit share, if you're making profits at the end of the year, that's all they're interested in. They rebate all your commissions back. So you're basically trading commission free.
Yeah.
So that's what really makes a lot of sense, because some of our best traders, and we can go through now, we have 120 traders in the firm. Some of our best traders make like 2 to 3 cents on average because they're trading large volumes. They're making small profits. They're not jumping in trades for $3, $4, $5. They're jumping in trades sometimes for 3, 4, 5 cents.
Wow.
So yeah, so it's a little bit different game. Small, like I would say on the time scale. Like I said, I do a lot of overnight trading, but I do a lot of short-term stuff too. And back in the day, sometimes my trades I would be in and out in less than a couple of seconds, especially on some of the automated stuff. Now on the other stuff, I do try to mix it up, and I do have a long-term investing account as well, which I try not to look at, because as a trader, you always want to overtrade your investment. So I try not to log into my investing account, but
Yep.
I've got core stocks in there that I've held for some of them for a lot of years. I've got like MasterCard in there, Apple, Google, and I actually have got about 70 to 80 investments, in my investment portfolio. That I would probably do a trade in there once a week, something, I might just throw in that I like the setup. So I kind of do, that's more of my investing stuff. Then I've got an interactive brokers account where I do a little bit of swing trading. And then I've had my day trading account, which is Ready Plus, Thomson Reuters Ready.
Dude, that's awesome, man. That's which is one of the things I wanted, the bright trading thing that's so intriguing is you'll hear a lot of traders when they talk about trading, they're like, man, I just don't have the money to make the living off of it. I'm like, no, the money's there, dude.
The money's there. We fund traders.
Yeah, that's right. The money's never the issue. It's can you trade well enough? That's the goal. Is if you can make money trading, the money can be there.
Yeah, and it's difficult to find those edges, that, and I would say my first few months at Bright Trading were a real eye opener. I came from retail in the bull market thinking I could do no wrong. And then you come in a prop firm and you're like trading short-term swings and you're trying to learn to short stocks and do a whole bunch of things. And I didn't make any money. Actually, my first 6 months, I think I lost about $3,500 over the first 6 months. I can remember I had a girlfriend at the time, and her mom was saying, "You've worked for 6 months and lost $3,000. What the hell are you doing?" And she's like, this guy's an idiot. Dump this guy."
That's right.
Anyways, but I could tell I was getting better. And then, by the end, actually, at the end of the year, I was actually up money at the end of the year. So I think I ended up $8,000 by the end of the year. And then the next year I made a lot of money, and then it continued to make, good living ever since. So this is how I make my living. This is how I've made my whole life. I worked construction as a young kid, and my father had a construction company, but almost 100% of my net worth here today has been made from trading. And the majority of it.
I'm really proud of you on that, dude. That's incredible. Like that's it's a phenomenal thing to hear, especially being in the game 19 years.
It's a long time. I feel old now, Jeremy. 19 years. I've got some gray hairs growing here.
Dude, I'm with you, man, on the gray hairs. Me and you together.
Yeah.
So regarding the trading, just to kind of make things, just a question, you mentioned the technical analysis and looking at the orders and the order flow. Do you use candlesticks at all, or are you?
Yeah, I do. That's the charts I use as candlesticks. Okay. And I do like to look at them. I will say I'm using a lot of different information. So I'm looking, at news. I'm looking at charts. I'm looking at, and typically, like in some cases, there will be trades that I make that I don't look at a chart. In some cases, I can just tell, by feel, by flow, by tape reading. I do a lot of tape reading. I feel I'm pretty good at it, like being able to identify when something's ready to swing. I mean, and that's a screen time. You can't teach that kind of stuff. You just got to get in there. And, after, if you start doing the math and start thinking about, let's just say I've averaged probably like 200 trades. It's 1,000 trades a week. It's 50,000 trades a year, 20 years. You're talking about like I made up like 1 million trades.
Yeah.
Probably more, because like some of those years I was making 500 or 1,000 trades a day. So, when you've traded that much, you just got screen time, and you're going to get a feel from reading the tape. So I've got my time and quotes going by. That's telling me, where the trades are executing, what exchange, how many shares are going. I've got my bid and ask up, which is, to a certain extent important. After hours, it's more important. Probably pre-market's more important. During the day, it's like I said before, a lot of it's just envelope orders, which aren't really solid, so you can kind of ignore them. But the odd time you can identify, like say for instance, an iceberg order. And what an iceberg order is an institutional order that's showing 100, 200 shares, but it's really a lot more size there. So you might have 100 shares that are offered there, and then it tries to get lifted for like 500, 1,000, 1,000. It's not moving. Well, now there's an iceberg order there. So this fish, this person that's sitting out there on the offer is not a small fish, it's a big fish. So what that can actually do is stop the stock from going higher. So when you can identify where those big institutional orders are, then all of a sudden you have a little edge on everybody else, because it's like, oh, well, this person might be selling 1 million shares there. Well, it might take 3 days to go through that price. So in the meantime, I could be shorting off that level every time as it comes down. So identifying where the big fish are in the market and trading in between them is something we've always done at Bright Trading, and something, that we specialize in.
That's really, really cool, man. Do you guys teach any courses on level 2 data or tape reading?
Yeah, we do, and I have a lot of educational stuff out there. And obviously, on the pre-market prep show, we're there every morning from 8 to 9. We talk about this kind of stuff.
Yep.
I probably should do more education than I do, but I've got some on my website, premarketprep.com. If you go to education on that, it's a website we haven't kept up that much. I'm a trader. It's my primary business. I've also got 2 young kids. So keeping up websites is not something I'm very good at, but this is something we put together a few years ago, me and Joel. We've got a little bit of education up there. Our show is up there every morning. It is delayed on this site, but eventually we're going to be live on that site too. But if you want to watch our show, it's actually premarket.benzinga.com is where you can watch the show as well. But we talk about all this type of stuff, different edges in the market, and we're just kind of giving our experiences over the years. Like Joel's been in the market since 1986, traded on the floor. He actually started Bright Trading, the office in Detroit, which I joined, so he was my trading mentor. So he's got a lot of experience there too. And we talk about all this kind of stuff on our show.
Very cool, man. Very, very interesting. I love that. One things I found most interesting is just that your style is so much different than others, and I can totally appreciate that. Right? Got to always be learning, always be growing. So here's the question I have for you. How many monitors do you have? 2, 3, 10?
You know what? Okay, so I've got my house and I've got my cottage, and I traded from the Bright Trading Detroit office until 2013. So I just in the last 5 years have now moved away from the office and trading from home. I've got kids at home, and the office we closed down simply because we used to have 25 traders in the Detroit office. Then we had 10. Then we had 5. Everybody likes to do it from home. I mean, with the internet the way it is, you can do it from home now.
That's right.
When I was at the Bright Trading Detroit office, I had 6. In Windsor, which is my home in Windsor, Ontario, I have 6 as well. At my cottage, I kind of run a little lighter operation here. Maybe I'm not trading as much in the summer, when I'm up at my cottage in the summer. So I have 3 monitors here, so I have to really utilize my screen. And basically, I've got my iPad in my lap too. So I have 3 monitors and my iPad. It seems to work. I like the 6 setup better, but the 3 setup works well too. So on my middle monitor, I guess I can't really show this, but on my middle monitor, I've got my primary trading software. On my right monitor, I've got a Bloomberg terminal, which is expensive. And I've also got the Benzinga Pro running. Basically, all my news running over there on my right monitor. And then on my left monitor, I've got scanners. And what these scanners do is search the market for certain criterion algorithms that I've written, that it's looking for setups. It's looking for different things that I've identified that I want to find. So the ticker will pop in. Sometimes in the case I used to have, in the case when the ticker pops in, I had automation running on it that would automatically buy or sell it. So you're talking about like idea generation is in milliseconds, where the scanner itself is identifying the idea, and then the automation is all in the background where it's actually executing too. I don't use as much automation as I used to now, because I find a lot of the strategies that I used to make money on, it's difficult to do because high-frequency traders are really good at taking advantage of any inefficiencies that can be automated away. So it's funny, I hear this all the time, oh, you got to get automated, that's the way to go. And I would say, yeah, in 2005, 2006, 2007, automation was awesome. Now it's like the manual trader, I think, it's come back, because the automated trader has taken away so many edges from the pros on the floor. I mean, you look at the NYSE floor, it was littered with traders back in 98, 99, 2000, 2001, locals down there trading for their own accounts, market making. I mean, they're all gone. The NYSE floor is a CNBC studio now for the most part. Wow. Like I was there 3 years ago. There's not much happening on the floor. And that's because it's all automated. But if you can be a human being and can identify those little inefficiencies, like maybe some newer ones there before the bots, I mean, there's a huge edge because you don't have all these other smart humans to compete with anymore. You're just competing against, machines. And if the machines haven't identified the edge, it takes some time. Machines got to, so somebody has to identify the edge and then go and program it, maybe back test it, implement. I mean, that can take sometimes weeks.
For sure.
And as a human being, you identify a new edge, you can take advantage of it instantly. So I will say it's funny, I was probably running, a lot of automated strategies back 2007, 2008, 2009. I don't run that much automation anymore. I find the human trader actually, has a big edge in this market. And in the sweet spot, Jeremy, and something that is time frame I think that you trade a lot, is this swing trade environment where you're in trades for like a couple days to a couple weeks. I mean, if you're in that sweet spot, there's not a lot of automation you're competing with at all. So that's just, a nice spot when you're not competing against machines. So, if you're in the 2-day to 2-week time horizon, you're not competing against any high frequency traders. You might be competing against some funds, some hedge funds and stuff, but for the most part, the high frequency traders aren't even concerned about you. So that's a nice spot to be in.
I love, when you told me that, and by the way, guys, so Dennis was in Nashville about 2 weeks ago. Me and him had lunch and we were chatting. That's when I was like, man, I gotta get this guy on the show. When you mentioned that, I thought that was really interesting because a lot of people are always obsessed with how hard trading is and high frequency traders and algos are beating the system. And I refer to them often. I don't necessarily think that's the case in all time frames. I mean, because you have someone like Warren Buffett who just has the simplest approach of all time, but is always beating the market. I mean, it's like if you have something that's simplistic and you stick with it, you're going to have losers. In any time frame, you're going to have winners. You just have to lose less than you win. Simple as that.
That's it. You just have to have that edge. Or, you can even, in some cases, I've seen successful traders actually have winners more than their losers, but they're so efficient at cutting their losers that, that in the long run they make money because their winners are just that much bigger than their losers. So it's actually funny. You can actually have more losers than winners and still be profitable in this game.
Absolutely.
You just got to be cutting those losers quickly. And that's the name of the game. I mean, this game, and, I've watched a lot of traders come and go. And the traders, you typically can identify them very quickly if they're going to make it or not because they don't have the discipline. It's a hard thing to teach people to eat a loss. I mean, I see this all the time, and and as a prop firm, I see people come in, they say, "I've never had a losing trade," and right away, this means you don't take losers. It means you hold on to your losers until they come back. So you're probably sitting on a portfolio of losers if you've never had a losing trade. That's not what we're all about, right? We're about cutting those losers, get out, get back in the trade. I mean, we're going to be wrong. We're making calls in this market. There's nobody that's 100% right all the time. And if they are, that means, again, that they're just not taking their losers, is sitting on them all, hoping they come back. And when you're in the hope trade, I think I've watched a lot of traders blow out their accounts by hoping the trade is going to come back. I'm not in the game to, play with my money. I'm in the game to play with the house's money. So I like to let my winners ride a little bit, cut the losers very short.
Yep. I mean, so what psychologically, how would you tell people to handle the losers? I mean, that does impact people. You're 100% right. How do you get over that?
I mean, you've got to look at it as when you lose money on something, and it depends on you, you've got to give it some leash. I mean, you can't just say, "Oh, I'm going to lose 5 cents on this," and you're going to get stopped out of everything. So you got to give yourself some room. Biggest thing I would say is just to have those predefined exits before you enter a trade. So say if this trade, I put the trade on and I'm going to go long the stock at say 110. If it goes down to 106, I'm out, and that's it. And if it opens down and gaps down at 103, you see this happen all the time, where it's like, okay, well, my stop was 106. It opened down at 103. Well, I can't sell now because it's way below where I was going to sell. I eat that loss right away. I mean, it's below my stop. I'm going to sell it probably on the open at 103 and eat the extra 3 points. Nothing I can do about it. News gapped against me. But I'm not going to let that small loser become a big loser. And if it's bigger than you wanted to eat, it's nothing you can do about it. I mean, that's the name of the game. Sometimes it's going to work in your favor. I mean, news can happen on any stock. And a stock can gap up or down. Sometimes it's going to work in your favor. Sometimes it's going to work against you. But the biggest thing is every single trade that I enter, I have a contingency plan for if it goes, if it starts to go against me, where I'm getting out. So identify your out before you get in the trade.
I love it. I love it. So good. I got 2 big questions I want to ask you, but I have so many, but these 2 I want to make sure I get at.
Okay.
regarding your Bloomberg terminal. So I don't know many who have made that investment. At what point in your career did you say, I need to invest in myself, I need to upgrade my trading station, I need to make sure as a news trader I have this news in front of me? How valuable is it, and how did you make that decision to put that kind of money into your trading?
Yeah, because the Bloomberg terminal, I believe, is $22.60 a month. So I'm talking $2,200. So it's expensive. You're talking about like $25,000 a year for a Bloomberg.
Yep.
There's not a lot of in our firm. The 120 traders in our firm, there's only me and another guy that have it. Two people have it. The way I look at it, pretty much, is if I can make more than $2,500 from it a month, I'm probably better off for having it. Now, and the funny thing is I spend even more on news. So I subscribe to other news services as well, because sometimes what Bloomberg has, another news service might not have, or sometimes another news service might break a story. So I'm very big on having multiple sources. Because I'm trading after hours, I need to absolutely know the news as soon as it happens. So Bloomberg will typically break a lot of stories. So that's why if you get, like I said, a few trades from a month, but usually we'll have the information as well. So if I can't find out why a stock is moving, usually it'll be in the terminal, or it'll be on one of my other news sources as well. I do use Benzing Pro. It's a cheaper version. I do use Fly on the Wall. It's a cheaper version as well. Those are good news services to find the big news. They get the big stuff. A Bloomberg terminal will cover you're going to get the little stuff from those guys too. It just might be a little bit, you might be a few seconds later. A few seconds of your trading news matters. So I would say if you're new and you're not into the news, you can actually get a lot of good news for free, even online. Twitter, is a great way to find news as well. But typically you're going to be pretty late to the game if you're looking at Twitter for news. It's going to be usually a news source that breaks it first, or Reuters or Bloomberg. So because I'm trading news, because I'm trading headlines, I need that, and that's why I'm not scared to pay up for information. I'm doing information arbitrage. I got to pay for information.
Yes. It makes tons of sense.
Now, if you got a Bloomberg, so I've got scanners running from the Bloomberg terminal, which are literally looking for what I'm identifying as important to me. I've got it speaking to me, so it actually will. Its computer voice is kind of annoying, but it speaks to me. So as something is happening, like if there's a major news, for example, like the Facebook data thing from China last night, it's going to speak out to me and alert to me that is happening. And, it can possibly make a trade from that. And it's fast. Sometimes you're not going to get the trade even, you're right on top of it. But, there's other traders doing the same thing. So it's competitive, very competitive news trading. But, if you're there and if you're trading it, there's still money to be made from trading the news.
Yeah. Oh, totally. So the question with news then, what does it take to extrapolate that data on the news? There's so many different ways that it can be presented. How do you know if it's bullish? How do you know if it's bearish? Do you guess? Do you always go with one direction? What's your take on that?
And sometimes you get it wrong, and it can sometimes be very ugly when you get it wrong. But some stuff is obvious. Stock's upgraded. It's probably bullish. Stock's got an offering. So stock offering, which means they're diluting the stock. It's probably bearish. Stock's doing a buyback. It's probably bullish. That stuff's easy. So that's, stuff that's easy. That's stuff that's automated too. So you're competing against bots on that kind of stuff. Yep. Now, when you get into more interesting things, it's kind of like, an earnings report. So is it bullish or bearish? Yeah, they beat on the top line. Yeah, they beat on the bottom line. But, how is the guidance? Is the guidance good or bad? What's important? How is it trending in this earnings season? Have we been running up into earnings and then selling off on the numbers? You've got to identify those trends early. So, like, for instance, last earnings season that just went by, the banks were, the banks are the first to report, so kind of get the good feeler. Well, Wells and JP Morgan report on the first day. They report awesome reports, and they tank on those reports. So what that is telling you is that these stocks ran up too much into the reports, and now there's just profit taking into them. And that trade actually worked well for the next ones that reported later, Morgan, Goldman, Wells reporting, Citigroup. And you could actually use that information because a lot of them gapped up on their initial numbers and then couldn't hold the gains and tanked. So when you can identify, what is happening earnings, same thing with the YY this morning. So you're looking at YY and you see, a pretty good report and it gaps down. Well, right away I was saying on the HUYA, Chinese company, nothing to do with YY fundamentally, but because YY reported a pretty good report, tanked on it, makes me think that HUYA can actually tank on their pretty good report as well. So it's interpretation, of those numbers but looking at previous ways that the stock has traded or other stocks have traded on the reports can kind of give you a little, tip off, kind of showing the market kind of showing its hand. And that's, edges that we're trying to take advantage of.
I love it. I love it. No, it makes sense. I mean, if you have a good earnings report and it's gapping down, people are going to be like, what the heck, bro?
I mean, that happens sometimes. But then, sometimes there's an advantage in that too. Sometimes the stock might be gapping down on an earnings report. But, like some of these retailers that were gapping down the report, retailers are just hot right now. It's like they're so hot that Macy's gets downgraded, and it's trading down now, but Macy's gets downgraded today. And within like a half an hour, it's back in the green. Why? Because it's just hot right now. Twitter, same story. They have a convertible launch there. This morning gets announced. That's dilution. That's not fundamentally good for the stock. Stock's trading under 39 in the pre-market. And within an hour, it's back in the green. Why? Because the stock is hot. So first thing you should always identify when you're entering a trade is the stock hot or not? And if it's hot, even when it's got bad news, it might actually still just turn around and rally on it because the stock is just in it's an uptrend. There's a lot of shorts that are caught on it. Maybe you're squeezing some people. Lots of different reasons for that happening. But, typically I'm looking at the chart. The chart has, been moving up. I know that stock is, and it's hot right now. So news that knocks it down sometimes will typically get bought right back.
Is there any sector that you don't trade or any stock that you don't touch?
I trade sectors within sectors. So no, I would say I trade everything. I would trade gold stocks with gold stocks, banks with banks, tech with tech. So I'll trade everything. Biotech is a little bit, I do trade biotechs. They're a little scarier to hold overnight because they are very prone to random news. Drug, gets approval, or, something, on a trial comes out. The other news, on your major stocks are often, when the earnings report is coming. They're a little more predictable. Biotechs are very random, so I'm often cautious. I never get really big in any one biotech position overnight, just in case some bad news comes out with a drug and all of a sudden, you're on the wrong side of it. Because that's the one thing about overnight trading is you get hit with news. When you have 50 to 100 trades overnight, you will get hit with random news all the time, almost every single day.
Yep.
I will have one or two stocks that's like, okay, there's news on this today. Now, how do I work out of it? I've got some bad news on this. I've got some good news on this. And you weren't prepared for that, but you have to know what to do. So if I've got, let's say 2 stocks today that have news, one is good, one is bad. Well, I want to maximize my gain on the one that's reporting the good news and minimize my damage on the one that's reporting the bad news. So when I'm on the wrong side of the trade, I'm trying to minimize that damage as best I can, whether that's working out in the pre-market, working out at the open, working out a little bit after, whatever I can do to minimize that damage. And then again, to maximize, the gain on the one when you're on the good side of it. So it's just trading skills.
That's right. What's your biggest or worst loser?
Worst loser I've ever had?
Yeah.
You know what? That's funny. I don't even know. I honestly can't tell you. In my investment portfolio, I could tell you. I've had some stocks go to zero. GE was a terrible one. I had GE in my investment portfolio for the better part of 18 years, Jeremy.
Wow.
I bought it at $30 back during, went from 60 to 30 back during the original tech bubble burst. And it went down to like $6 during the financial crisis, back up to 30. I actually just recently sold it all out because I'm just like done with this story.
Yeah.
And so here I am, literally 18 years later on General Electric in my investment portfolio, and I'm selling for like a 26-point loss. So, or not 16-point loss. So I lost like 60% over 18. So I've had some ugly ones in the investment portfolio, but I've also had some good ones too. I mean, I'm in MasterCard from like $16 or $11.
Legend.
So, so many years ago, my cost basis on MasterCard, I think, is $11. It's at 201.
Good for you.
Yeah, you're up like 13, 14, 1,500%. That's one thing I will say, and a lot of people, struggle with this in their investment portfolio, and I see this happen all the time. If you're going to take stocks to zero, that's okay. But make sure you're not like cutting all your winners short. So you've got to have some huge winners too to make up for that. So I've got the Warren Buffett approach. Sometimes I'm going to be wrong. Sometimes I'm going to, in the case of GE, I feel like I'm finally wrong. I feel like this, maybe this is the bottom. I've sold it now. Maybe it's the bottom, but whatever. It's something that, I just don't believe in anymore. The story has changed. They've got problems. You have Deutsche Bank, talking about this could be in single digits. They might have to do another capital raise. And there's so many unknowns. I'm just like done with it. So I'm not afraid to take that loss, but At the same time, sometimes I believe in the story, I believe it's going to come back, and it doesn't come back. I mean, it's just cases of that. But if you're going to hold stocks, and lose 40 or 50% on something in your investment portfolio, make sure you have a few that you're making 100, 200, 300% on, because it will make up for it.
Absolutely. No, dude, you are 100% correct.
And the trading portfolio, I cut the stuff quick. I mean, I'm usually out, very quickly.
No, you're absolutely right. I texted someone this today. I said, investing is all about holding and patience. If you use it and you love the company and the product, no reason to ever sell.
And that's why MasterCard, I look at this and I'm like, I don't know. I actually have sold part of the position on the way out, but I've taken way more out than I put into it here. And now I'm just like comfortable with them. It's 201. It keeps going up. I still believe in the story, the multiple. I do fundamental stuff too. I've got my CFA, so I know I sit there and crunch the numbers sometimes too on my investment stuff. And I mean, it still makes sense for me here. If the story changes, I think competition is going to start to heat up for the MasterCards and Visas of the world, then maybe I'll turn around and sell it. But right now, I still believe in the story. But so there's some good and some bad, and that's investing. That's a different animal.
Yeah, no, makes sense, man. Makes sense. If anyone has any questions for Dennis, feel free to throw it in there because we're about to wrap up. Robert has one question. He says, so on MasterCard, are you going to sell? Do you have a plan to sell? Are you going to do a collar? Or
no. And you know what? And I used to do some options writing on some of my investment stuff. And I think there's, money to be made there. In a sideways market, nothing works better than like writing covered calls against your investment positions. And there's no better market for that than the sideways market. The down market, you can sometimes get hit because then you can end up with, a lot of portfolio of losers because you're writing upside calls. Stocks are going down. You're not getting called away on nothing. And all of a sudden, you're left with a lot of losers in your portfolio, even though you brought some option premiums. And in a bull market, when you're writing a lot of upside calls, you get called away on stuff. And maybe that's good. You can just continue to do it. And obviously, there's lots of money to be made with options there. In a sideways market, nothing better than writing covered calls. I used to do a lot of it. And then in 2000 and or 10, 11, when the market really started to take off, I got called away on so much stuff. I was like, man, I'm leaving a lot of money on the table. I can remember buying eBay for $11, right in the upside 15. So I'm leaving myself some room for like $1. So I'm averaging on eBay at $10. And this is, prior to the PayPal spinoff. So we're talking like some serious, money. It's up seriously from then. And then things at like 25. So I'm like, wow, man, I could have actually, still in the stock. And here I'm getting called away at 15. I did get that extra dollar amount at 16. It was a good trade, 11 to 16, but could have been 25. So it's funny. There's a time and place for writing covered calls on investment stuff. I think it's a great strategy. There's a lot of options traders. Nick Shaheen's another one too that, do this as a living and writing, and doing a lot of option writing in the shorter term. And I think that's, great. You got to manage those positions a little bit more. But on the MasterCard, I'm in it. I mean, I'm probably just going to keep riding it until I feel like the story has changed and I don't want to own it anymore.
Oh, makes sense, man. So one of your neighbors to the north, your buddy, says, are you looking at CGC because of the vote tomorrow?
Looking at the pod stocks, these are a little bit more speculative. I would say I trade more, I was bringing up the SOGO and the IQ and stuff. Those are kind of exciting stocks. But a lot of my core strategies are more boring stocks. I trade a lot of banks, a lot of stuff that's more predictable. And stuff like this is definitely not predictable. I mean, you can look, you can say, yeah, it's in an uptrend. Yeah, it looks good. But this could be, a situation where, it's run up into the news. Maybe this is going to be one of those cases of buy on, not buy on rumor, but buy ahead of the news and sell on the news. It could be. Yeah. I don't know. I don't think I'm following the pot stock story close enough to really feel comfortable trading it. Maybe trade ahead of the report. And there's definitely a strategy, ahead of the news. There's definitely a strategy to be made in some alpha to extract from trading things ahead of scheduled events, because typically stocks will run up ahead of a scheduled event, and then you don't know what's going to happen ever. You have the coin flip of the event itself, but a lot of times you see positive strength. Like Nvidia, when on its last quarter there, NVDA, it ran up $30 ahead of the report. Why? I played this one and just ahead of the report as well. It ran up like $3, $4, $5 ahead of the report. So I sometimes buy them 2-3 days ahead of the report, sell them before the report, not to take the risk of the event, but just trying to extract the alpha of people want to be in, ahead of the report. So again, same thing appears to be happening in CGC. I mean, here's a stock that's kind of straight up here last 6-7 days, and maybe it's going to be up ahead of the, news of the legalization, the official news.
I love it. Last question, man, for me.
Sure.
What's the biggest company in 5 years in the world?
I'm going to say in 5 years, I'm still going with Google, man.
Google.
I love Google. I am. They just have so many irons on the fire. They have a monopoly on search, unless there's something eventually going to come out better. I mean, Google just has that cash flow. I always say, like, you can look at, Facebook, and you can look at Twitter, and they're trying to get you to click on something to make money. So they're putting ads in your face, hoping you click on it. When you go to Google, you are looking to click on something. I am literally looking for something to click on something.
Yep.
So it's such a good business model. That core model itself is awesome. And then they have so many other irons on the fire as well, all the other stuff they're doing. I still am a firm believer in Google. It's one of the biggest positions in my investment portfolio. And its valuation, it's like the GARP, growth at a reasonable price. You're still getting earnings growth. The PE is not crazy. It's like trading 19 or 20 times forward earnings.
Yep.
So it's not, much more than a market multiple right now. I think the market's at 16 or 17. Yet you still got all this upside. They got so many other irons on the fire. They're doing other things. They're going to be involved in everything. So I love Google. I still own Apple. Apple's a good one too. I think Apple's probably going to be the first to $1 trillion. I mean, that is just, value, but it's an iPhone play. Half the money comes from iPhone. It's kind of a little bit of a one-trick pony, but I think they got more tricks coming. So I'm sticking with Apple, but I love Google, and I'm going to stick with Google.
Dude,
5 years from now, I think Google is the most valuable.
I love that answer because I honestly, I echo it 100%. I was telling people the other day, I think in the next 5 years, with the whole Jeff Bezos becoming the richest man in the world thing, we're going to see in the next 5 years, the richest man or woman in the world flip-flop back and forth numerous times along with the biggest company. And Google will 100% be there. If it's not the biggest one, they're in the runnings. I mean,
they're up there.
They're in the runnings now, so they're in the top 10, no question.
A lot of smart people work at Google. I mean, I went on a vacation about 5 years ago. I don't take a lot of vacations, but it was a trip through Great Britain. And I can remember this one kid was on the trip, and he had just got hired at Google. And I was like it was like a 1 week trip where we were on so we get to know people. I'm like, man, this kid is smart. And, this is the kind of people they find. They find these really smart kids. And his whole job was just to work on Google Maps. He was hired in. It's like there was like 40 people that work on this and just perfecting it. So, I mean, and this kid is just like so smart. You can just tell, like, just grasping things so fast as he taught concepts with him. He wasn't even a trader, but he could grab things so fast.
Yeah.
The kind of people they find. They find all these smart. This was a kid working in the maps department at Google. I mean, there's so many smart people that work there, but they all find these people. Yep. And it's through the interview process. They do like problem solving in these interviews. They do some phenomenal techniques to find the best talent.
I love it, dude. What a phenomenal interview, man. Thank you so much for spending your time with me. I truly do appreciate it. I'll send you the link later. But yeah, man, I look forward to many more conversations with you in the future, my friend.
Okay, Jeremy, thanks for having me. Good luck to all you traders out there. Happy trading.
All right, man. You too. Take care.
Yeah, take care.
All right, ladies and gentlemen, there he is, the man, Mr. Dennis Dick. We'll be hearing from more from him in the future, I'm sure, in some form or facet, but really good trader, trading a lot professionally for 19 years, incredible stuff, learning a lot of information, education there. Good stuff, very good stuff. Starbucks. So we played Starbucks during that interview and got out for a very small gain. I made $42. No big deal. What inspired me was when Dennis was talking 2 or 3 cents, buying enough shares. I was sitting there thinking, well, I got 3,300 shares on Starbucks and I'm up 4 cents, So anyway, that was, I could have exited the whole thing, but anyway, I just took out some pieces. The 10 EMA on the 15 just was looking too strong. It didn't break down. No big deal, right? Small gain, actually. I'll take a small gain all day long, ladies and gentlemen. I don't think anyone else does anything else. If you are, let me know. I'm going to bounce. You'll all see me from 5 to 6 p.m. Eastern Standard Time for Energy Wednesday. Next week, I plan on having an interview with a real-life trader. And then the week after that is the free open house week for the entire world. We're probably going to have over 1,000 people in the trading room that week, folks. So go ahead and get your keyboards ready. You're going to have so many people asking so many basic questions, and we all get the opportunity and the privilege of helping teach people truly how to understand and grasp a concept that can totally change their life and their family's life forever. It's going to be a really phenomenal time. So many of you have already begun that process of making massive mental shifts in your approach to the market and your approach to life. So I'm proud of you. Thumbs up all around, big internet hugs. You are all amazing, folks. And I'll see you this afternoon. So until then, love life, and trade it. You guys rock.